Hello. Welcome to this week's Private Funds Update. I'm Sandra from SmartEsq. Here's what I learned this Thanksgiving week. First up, the SEC Division of Examinations released its 2026 priorities on November 17th, marking the first examination roadmap under Chairman Paul Atkins. Here's the key takeaway for private fund managers. While the tone has shifted, the scrutiny hasn't. Chairman Atkins emphasized that examinations should provide transparency and enable constructive dialogue, not be a gotcha exercise. But make no mistake, private funds remain a core focus. The division has simply reorganized how it presents these priorities, folding private fund issues into its broader investment advisor section rather than maintaining a standalone category. So, what's the through line here? The SEC is laser-focused on retail investor protection and fiduciary duty, and private funds are increasingly touching retail investors through vehicles like interval funds and tender offer funds. Here's what private fund managers should prioritize. First, the division is targeting alternative investments with specific attention to private credit and funds with extended lockup periods. They're concerned about liquidity mismatches and whether advisors are adequately disclosing these risks. Second, if you're managing both private funds and separately managed accounts, expect scrutiny of your allocation practices. The SEC wants to ensure you're not favoring one client type over another. Third, managers who are new to the private fund space face heightened risk. The division specifically calls out reviewing these firms for basic regulatory compliance, including valuation practices, fee disclosures, and proper use of side letters. Here's what else you need to know. The absence of certain topics doesn't mean they're off the table. Crypto assets aren't mentioned at all, a clear policy shift, but fee and expense calculations aren't explicitly listed either. And even though multiple law firms reported around this time that they continue to see examiners asking detailed questions about these areas in every examination. Bottom line, the SEC's message is continuity with a collaborative veneer. They expect robust compliance programs covering marketing, valuation, trading, portfolio management, disclosures, and custody. The fundamentals haven't changed. Now to our second story. On November 10th, Judge Jeffrey Cummings of the Northern District of Illinois denied the FTC's request to block GTCR's $627 million acquisition of SmartEsq. This was the FTC's first fully litigated merger challenge under the second Trump administration, and they lost. Here's the background. GTCR already owned a majority stake in BioCode, the nation's second-largest supplier of hydrophilic coatings for medical devices. The proposed SmartEsq acquisition would have given them the largest supplier as well, creating a combined entity with what the FTC argued was a 60% market share. The FTC claimed this violated Section 7 of the Clayton Act, citing the 2023 merger guidelines and arguing the concentration alone established a presumption of illegality. But GTCR successfully rebutted that presumption on three critical grounds. First, the court rejected the FTC's reliance on legacy revenue data, finding that because medical device manufacturers select coatings before FDA approval and rarely switch afterward, past revenue doesn't reflect future competition. The court found GTCR's bidding data more persuasive. Second, and this is significant for future merger challenges, the court held that the FTC must analyze proposed divestitures as part of its competitive effects analysis, not separately. GTCR's divestiture agreement with Integer Holdings was deemed sufficient to preserve competition. Third, the court found that the FTC's market definition was too narrow, failing to adequately consider medical device companies' in-house coding capabilities. This decision represents a major shift in how courts may evaluate merger remedies going forward. That's our weekly update. Have a wonderful Thanksgiving. We'll be back next week with more updates from the private fund space. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesq.ii.